This series of videos will walk you through a problem when we're accounting for investments when the size of the investment ranges between 20 and 50%, and therefore we're required to use the equity method. So here's the problem that you should have available to you through the course software website, and if you haven't gone through and tried this, I would recommend you try it before watching the videos. This video is the first video which will walk you through the accounting for the acquisition of the investment, given all this data above. So at acquisition, here's what's happening. We are Google, and we're buying shares of Wacom Inc., and therefore we're going to give cash and we're going to receive stock in exchange. The problem tells us that this Wacom company has 200,000 shares outstanding. The size of the purchase, the number of shares we're buying are 50,000, which tells us the size of the investment is 25%, and that falls between the 20 and 50% range, requiring us to use what's called the equity method. But when we acquire the stock, we always record that transaction at its historical cost. And if you refer back to the problem, they tell us that Google had to pay $710,000 to purchase this stock. It makes no mention of fees or anything. So the journal entry is very straightforward. It's the same journal entry that you've experienced when we purchase stock and our size of our investment represents less than 20% of the shares. We debit the stock investment for the total cost, historical cost, and we credit cash for the outlay. And that's it for this first requirement in the problem.